There we go. Okay, well, welcome everyone for spending this evening with us. I'm excited that we have Members Mortgage on here and we have attorney Mr. Golas on here with us, where we'll be going over mortgages, what to look for, what's happening in the industry, best practices, all those good things. We have Joe from Members Mortgage. He's the president and he's been there for so many years that I'm not even going to embarrass you to tell them. But and then we have David. He is the president of Golas Golas and Golas. He's still young, so he's only been in practice for attorney. What is it, 28 years now?
That's it. Yeah, young. Yeah,
Yeah,
a young 53.
there you go.
Yeah,
And I always like to mention this. I think it's really cool that you actually started with your dad, right? You guys
yeah,
started the yeah, excellent.
that's
So nice
correct. Yep.
family business, and that kind of ties back into the way that credit unions operate. And we try to, really keep community in mind and offer these educational seminars like this to be able to help our members and people in our community make wise decisions. So at this point, I will turn it over to Joe.
All right, thanks, Octavia. I appreciate it. It's always good to be here with our credit union folk. I think that this is one of the more interesting markets that we've seen probably in the last 30 years. We're going into an election cycle. Typically, when election cycles come around, the incumbent is pushing for lower interest rates. So pretty much every analyst that you read out there is going to be talking about how they anticipate rates are going to come down. Rates were previously at the end of last year the highest that they've been in 30 years, right? So some of your parents, if you're a first-time home buyer, or if you're looking to downsize, when you bought your first home, you're probably looking at similar rates to that. I'll kind of lay out the interest rate environment. I'm going to go over some of like the macroeconomic factors that are kind of ailing the housing industry. I'm going to go through the requirements of buying a home with conventional financing. I'm going to go through some of the new programs that are come out through Fannie Mae this year. We're going to talk about just kind of the beginning to end of buying process from the initial application for pre-qualification to the actual closing date. I'm going to bring in attorney Golas to talk about all that he does to make sure that the actual closing takes place. And then at the end, I'm going to give you a couple of tips on what I think you should do going forward. I'm going to give you a special promotional code for attending the seminar. I'm going to kind of give you some things to look out for as you go through this process. A couple of tips from an insider, and then at the end we'll take some questions. If at any point during this session you have questions and you'd prefer to not ask them, of me later on, you want to ask them in the group, you can always use the chat function. So if anybody has any questions or things they want to pose to me as I go through, I talk very quickly. It's like a second language to me. So if I say anything that doesn't make any sense, quickly just shoot me a message in the chat function, and I'll be sure to either answer it there if it's specific to you, or answer it for everybody if I think that I stumbled across something that I was talking about. So let's start off by talking about the housing market right now. Connecticut, it is a feeding frenzy. There's not a lot of inventory. We've had a very mild winter, right? You had a few storms here and there, but really, for the most part, it hasn't been too cold. Not a whole heck of a lot of snow, which typically allows people, when they feel this pent up demand, to jump the inventory. March has traditionally been the beginning of buying season. We saw some houses come up for sale in February, easily digested by the market. There's usually about 10 bidders per home. All right, so if you think about that, I think that a lot of people had this idea that, hey, interest rates are going to go up. The housing market is not going to hold. There's going to be a significant devaluation of real estate, especially in specific areas of the country. Connecticut has traditionally held their value pretty well. The Northeast in general has really held their value pretty well. There's a lot of employers up here, so there's not a lot of forced selling. So what we've seen is actually too few homes for the number of people looking to buy homes, which has steadily driven prices higher. At the beginning of 2021, the average home price in the United States was about 260,000 or so, and now we're eclipsing 400,000. So the price of the homes are getting much, much more expensive, especially for the starter homes. And then on top of that, interest rates back in 2021 were somewhere in the 3% range, we'll just say. Now we're looking at interest rates in the mid to high sixes, low sevens. So it's twice as expensive from the cost. It's twice as expensive from the interest rate environment. Now, why would anybody want to buy a home, right? It doesn't make any sense. Well, actually, if you think about it, right, there's no better opportunity than now. If you look at buying in 2021, everybody said, hey, these rates are ridiculously low, but the houses are way too expensive. I can't buy now. They've lost all of this opportunity to build equity, to retain that low interest rate, even though at the time they thought, hey, it could never get more expensive. If you ask your parents what they bought their first house for, or grandparents what they bought their first house for, and they thought, hey, it can never get more expensive than it is now, I have a feeling that it's going to keep going up, especially in this area. So if you're making that decision to jump onto the treadmill going full speed, this is probably a decision you're going to grow to appreciate, right? You look back in hindsight, go, wow, that was a really smart decision. So as you're looking through this inventory, you're going to start seeing more and more listings come on. Right now, there's very few because everybody is still kind of getting used to the first week of March as the buying season. As the homes start to be digested through the system, people are bidding on them, people are getting them under contract, more and more sellers are going to come to the market. And that's really what the housing market needs right now, right? There's so many buyers, right? There's so many buyers and there's so few homes. And what a lot of people have kind of put in their mind, the seller's mind, is that interest rates are high, so this isn't a good time to sell. Now, the market is showing differently. The market's showing that it actually is a very advantageous time to sell because, again, there's 10 buyers for every home that comes for sale. So as that stalemate starts to break, where there's more homes coming for sale and there's more buyers to buy them, you're going to see a much more normal market, right? Where you can actually go in, view the home, and make a bid on it and not have that feeding frenzy that we're seeing at the beginning of the season. But we need those sellers to come to market. We need that stalemate to break. And at this point, we haven't gotten there. So it is a very, very aggressive time period to bid on homes. So what I would anticipate that people should do is be prepared, right? Everybody thinks that they're prepared to buy a home. They think that they can look at Zillow and Redfin and Trulia, or Coldwell Banker, William Ravis, whatever website you want to go to, and just look at inventory and then just go out and look at a home and make a bid on it. There's a lot of prep work that takes place in this time, right? Before you find the home of your dream, before you're ready to go out and really commit to buying a home, that you should be doing, that will kind of set you up to be a more qualified buyer, to make the process more enjoyable, right? Because I think that a lot of it is going to be stressful if you kind of go into it without understanding the full process. And so I'm going to try to touch on a few of those things today. All right, so let's kind of go over the initial qualifying characteristics of getting a mortgage. Right? Everybody kind of thinks, hey, I got to put 20% down. I got to buy a single family home. I got to get in here and I got to do all these things that my parents did when they initially bought their home. Now, that's not necessarily true. There's a lot of different programs. There's programs for low income. There's programs with down payment assistance. There's programs with as little as 3% as a down payment. At the beginning of this year, Fannie Mae and Freddie Mac came out with a new program where they'll actually allow you to buy multifamily homes, so 2 to 4 unit properties with as little as 5% down payment and still have it be qualified under conventional financing. They're really trying to help with affordability issues, and this is a great way to kind of get into that first home, have some rental income to support the payment, and have a limited down payment, as opposed to before when you were looking at somewhere between 15 and 25% needed for down payment. So if you're a first-time home buyer, you're probably not looking at those 2 to 4 unit properties. You're probably looking at single families and condos. So let's focus on that. So if you're looking at single family homes and condos, you're going to need at least 3% of the purchase price as your down payment, right? So when we're reviewing your initial application, you're first talking to us, we're going to say, hey, what do you have saved up to put for a down payment? So we're going to verify that A, you have at least 3%, and B, that you have the necessary assets to put that 3%, right? Makes sense. We're gonna set a pre-approval letter for you that says that you have at least 3%. We're gonna make sure that you have it in order to give you that letter. The second thing we're gonna look at is your credit score. Right? Credit is really important, especially now. Again, in January, the FHFA with Fannie Mae and Freddie Mac came out with new rules on how rates are calculated, how they can be offered, what the property types that they'll lend on, what the down payment requirements. So part of that is they made a very concentrated tiered system for your credit. So before, if you had over 740 credit, you were in the prime category. You were in the excellent category. Now that tiers up to 780. And there's actually 2 other tiers. Now it's 760 to 780, 740 to 760, where your rates and terms could be impacted, right? So even from that perspective, you should really be focusing on figuring out your credit position now before you have a house of your dreams that you want to buy, because say it's your credit card balance is a little bit too high, or you were just late on a an auto loan payment or something like that that you weren't aware of. When you have the house under contract, you don't have the time to fix your credit, to call the creditors to make sure that everything gets situated and your scores can get changed back. But if you go and get pre-qualified a couple months before, right? I'm not saying you're going to go a year or 2 years before. That doesn't make any sense. But if you're going, let's say 2 or 3 months before you're really serious about making a bid, then you can look at your credit scores. You can look at your trade lines on your credit report. You can understand the different factors that go into how your credit score is calculated. And if your credit score comes in at 760 or 740, you can do things to your payment cycles that may, save a little bit less each month, but by paying down some debts or paying off some debts, you might be able to put yourself in a situation where you're going to be saving on a mortgage for the interest rate that will last you for 30 years. So you'll save 50, 60, 70 bucks a month, but that's for 360 payments. So that's a significant amount of savings over the term of the mortgage, right? And then the last thing that we're going to look at, which is kind of a little bit nuanced, is this concept of your debt to income ratio. Okay, debt to income ratio is what we use to qualify you for what you can afford. Now, a lot of people say, Joe, I don't know if I can afford this payment. What can I afford? The reality is that that's kind of a personal decision of what you can afford from a monthly cash flow perspective. But from my perspective, I'm looking at what I can get you qualified for. So we take your minimum monthly payments on all of your outstanding debt, things like your car loan, your student loans, your credit cards, any other mortgages that you have, plus a proposed mortgage payment. We don't necessarily know what your house is going to be. We don't know the taxes. We don't know the principal and interest. We don't know the loan amount, but we're going to guess, right? And we're going to kind of put you in the high end of what you're looking at, right? And we'll take the housing payment for that. And then we're going to add that to your other monthly liabilities. And we're going to divide that figure by your before tax monthly income, right? That's a lot of words, but basically what we're doing is we're taking your monthly payments, dividing it by what you make each month. And that ratio needs to be below 45% in order to get that qualified. Now, a lot of people go, okay, I can do this myself. I'm going to go in and I'm going to take my payments. I'm going to try to go to some mortgage calculator online. I'm going to try to figure it out. You can do that, but sometimes the way that we calculate your income may be a little bit different than the way you calculate your income. And it's also something where if you go in and you get commission or bonus or overtime, or you've been on the job for less than 2 years, or there are other extenuating circumstances, it's better to have all of those things laid out with a plan ahead of time so that you understand the realistic expectations for your goals of buying a home. Some people, hey, I just opened my own business, right? I opened it up in January. Unfortunately, it's probably going to be a really tough thing to get a mortgage with self-employed income with less than 1 year of history. Whereas, hey, I just started a new job. I was working in an old place for 10 years. It's the same line of work, but I just started in January. Is that a problem? Not a problem at all. We can show the continuous history of employment, and we can show when you left your old job and when you started your new job. It won't be an issue. As soon as if you're in receipt of one payment of a salary, we can use that salary to qualify for a loan. Again, all of these things are kind of barriers that would stop you from qualifying for a mortgage. And we want to make sure that we get all of those cleared so that when you do find that house that you want to make a bid on, you're ready to go and everything can be streamlined. And from start to finish, it shouldn't take more than a couple of weeks really to get your initial application in and get your loan cleared to close at least. Okay. So now let's talk about mortgage insurance. This is a big topic right now. A lot of people, their parents are like, oh, you can't get mortgage insurance. It's so expensive. It's so expensive. So any loan that has less than 20% down is going to be required to have mortgage insurance, right? And mortgage insurance is a fee that you pay every month to an insurance company that protects the investor of your mortgage in case you decide you're going to stop paying. And so you don't get any benefit of it. It's going to cost you some money. But the reality is that coming up with 20% down is prohibitive in a lot of situations. So mortgage insurance, although yes, it's a fee, you do pay it every month until you pay your mortgage down to a certain percentage. It's a great way to get your foot in the door to start building equity, right? Every month when you write that rent check, that's paying somebody else's mortgage. That's not paying your mortgage. It's not building up any of your credit. It's not building up any potential savings in the future. If you can get your foot in the door with less than 20% down, but you have MI, it's kind of a fair trade-off because you get to own the home. And the nice thing is the loans that we write are all conventional mortgages. So if you pay your mortgage down to 78% of the original purchase price, you don't need to refinance. The mortgage insurance premium will automatically drop off your payment. And so it's a great way to kind of, initially you pay a little bit more, right? But in the end, you can end up in a situation where you don't have mortgage insurance and you're not forced to refinance. The reality too is that if your interest rate is low enough, right, sometimes mortgage insurance is better than trying to do like a first mortgage and a second mortgage, right? So I think that you're in a situation where you should be focused more on finding the right home, even if you have less than 20% down. And we can send you quotes for 12 different mortgage insurance providers, and we'll make sure that we get you the lowest premium out there. And also by working with a credit unions get advantageous rates and terms on things like mortgage insurance. We also get discounted title work from somebody like Dave Golas. We get discounted appraisals from our appraisal network. So it's a great way to save some money on the front end at the closing versus the monthly payment. All right. So a lot of things we've covered, but mostly we're talking about the requirements of getting the loan and the market. Now let's kind of talk about who you're competing against, right? There's, again, 10 buyers for every home that's coming on for sale. They're 22 to 38 years old. The ages are actually getting younger, which is crazy. This used to be 25, 26 was when people started buying homes. I'm starting to see 22-year-olds applying for mortgages. 22 to 38 is your typical first-time home buyer. They're very tech savvy. They're very fast with information transfer. So you should be on the Zillows, the Redfins, the Trulias, the realtor.coms, the Caldwell Bankers, the William Ravises, whatever site that you want to watch real estate on, set up an alert, right? Go in there and say, hey, this town or this price range or this type of property, right? If you're just looking at condos, you're just looking at single family homes, you can set it up as wide or as narrow as you want it to be. And you should just have those listings sent to you, just so you can get a feel for the market, right? You can see the prices, you can see the characteristics that you're able to see on the market, right? Number of bedrooms, number of bathrooms, the condition of the kitchen and the living room, and the roof. You can see all those in the pictures. So as you kind of get used to looking at all of these types of listings, you become a more educated buyer because you go, okay, in this town, in that price range, I'm looking at a home that might need a little bit of work. Or, hey, in this price range, this house is going to be pristine and I don't have to do anything. So from a budgetary perspective, you have to start evaluating, am I handy? Can I do some of this work myself? Or am I going to have to hire somebody to kind of fix up the homes as I look at them, and evaluating the cost benefit of the fixer-upper versus the new build. Right now, there's a big push for new build. There's been a lot of homes coming up as new construction homes, and it's mostly because the inventory stalemate that we talked about earlier, where there's not a lot of single family homes coming up for sale. So as you kind of evaluate, remember, new construction is always going to be a little bit more on the the high end of the spectrum, and the existing homes may not be as beautiful and modern, but with a little bit of cleanup, you might end up with a home that's a significant equity builder for you. So it's important to understand the characteristics of the homes that you're looking at. It's important to understand the markets that you're looking for. And so as a consumer, as a buyer in the real estate community, you want to make sure that you're out there just looking at them, even if you have no interest in buying at this time, so you can familiarize yourself with things that are important to you and that are maybe less important. All right. Okay. So the next thing, I've talked about applying for a mortgage a lot. I haven't really gone over what that means. So I partner with the Dutch Point Credit Union. We've been lending together, I don't know, 15 years or so. And I have a team of mortgage experts here that are here to basically custom walk you through your mortgage application. No two mortgage applications are going to be the same. So what I want you to do is, when you are done with this webinar, to go onto Dutch Point's site, go to borrowing and then mortgages, and there's a mortgage click site, which is a technology that we offer that is an educational tool. There's all sorts of buying resources, there's checklists, there's rate calculators and closing cost estimators, and there's also a pre-qualification application, right? So when you go and you start your pre-qualification application, you may not necessarily know the answers to all the questions. If it's actually what town you want to buy in, what price range you want to buy in, what you have for a down payment, what product you want. Do you want a 30-year? Do you want an adjustable rate? There's so many different things that go into that. But what we want to do as a lender is we want to get you started from the very beginning so that we can coach you through the process, right? So when the first day you create a username, you're assigned to a mortgage professional who is both an originator and an underwriter. So what an underwriter does is he's the person who signs off on the approval of your mortgage. So when you apply and you're talking to the underwriter, you get to actually hear right from the horse's mouth what you're going to need to do in order to get this loan. So that it's a huge barrier out of the way for you because there's no surprises. So when you say, hey, I have this scenario, they already understand what the scenario is, what they need to in order to approve your loan, and they'll guide you through that from the very minute you apply all the way to the closing table. So from your perspective, you want to make sure that you're totally forthcoming, say, hey, this is my scenario, this is what I want to do, this is how I want to do it, and this is my timeline. And they'll make sure that they set up everything in a way that you're going to be successful, right? And again, if they go through your application, they find something that you may not be aware of, their job is to bring it up to you so that you can fix any of those problems now, right, before you have the home under contract. And that's why pre-qualification is so important, right? Everybody thinks that they can just go out and start applying at lenders as soon as they have a house under contract. The reality is, I don't think that a realtor would accept a bid if you don't have a pre-qualification letter. So if you're out there actively looking now and you're in a situation where you think you might be, getting closer to getting a house under contract, go through this process, really understand where you stand from a financial perspective, and it will just make you, again, a more aggressive buyer, and the realtors will take you more seriously as you go through this process. All right. So as we kind of talk about bidding on homes, I think that there's really three important people. The first one I want to point out is the lender, right? So I'm the lender. I'm going to talk about myself a lot tonight, but the first I want to talk about somebody else before I get to myself. So the lender is very important. The realtor is very important, but I think that somebody that's also very important, equally as important, is your attorney, right? You want an attorney that knows the local market, that understands the process and how everybody acts in a certain market. So as we go through this process, I have a set list of attorneys that work with me, including Mr. Dave Golas, who is excellent. I'm going to bring him on now to talk about what he does in the process and how he adds value to the members.
Hi, thanks, Joe, and thank you, Octavia. So what happened, my office is in Manchester. It's a smaller office. I work with my brother. We're very local. We have been lucky to partner with Members Mortgage and Dutch Point for many, many years. When I get your file, generally would be after you've met with your realtor, you have a contract, you have Joe and his lenders and Octavia working on the background. I get your contract in your file and we call you and we introduce ourselves. And the number one reason is I have a partnership with Dutch Point and Members Mortgage where I am a preferred attorney. So I have set fees that I abide by that are disclosed to you at the very first time that you get your initial estimate of closing costs, what my fees are for an attorney, for my expenses to do title searches, and it doesn't change. It's exactly the same. So I would introduce myself and hopefully you would say, I choose to use Golas, and basically I would handle your file with the sellers, with your lender, with Members Mortgage and Dutch Point, all the way through the closing, and I would deal with just only one other attorney. I can't, and Members can't, and Dutch Point can't force you to use me. You still would use me, but you could also have your own attorney. And what happens is that just increases your expenses. And most people, when you're buying your house, 2, 3, 400,000, Joe says is the average price. You're spending a lot of money, but the number one question I get when I introduce myself is, how much are you going to charge me? And I charge you, to be quite honest, very little. It's a lower fee than I see out there for everyone. I don't charge you any extra. There's no wires fee. There's no copies fees. So it's a set fee. So it's a good deal if you decide to just use my office. I also am very aware of Members Mortgage, their requirements to get your closing done on time. There's a closing date that you're going to have in your contract, and I know exactly how to get that there. And if I don't, I know how to talk to Joe and I email the loan officers directly for any issues that might come up that are out there that might delay your closing, and we try to 100% get you closing exactly on that date. Also, one of the important things is after you have your contract, there's dates that I could advise you on that usually it's already signed. You have a mortgage contingency to make sure that you're approved. Fine, you might have pre-approval, but you need to be finally approved so that you have your money available to get to your closing date. My office also does in Connecticut. Almost every town has its own town hall. There's title records that are there. We do a title search of the property, and that fee is already built in to the Members Mortgage fee. We search the title, make sure the owner is there and that there's clear title. We work with eventually getting you to your closing date, where we have the sellers that we work on the figures. And one important thing I think that happens is once I get your file from Members Mortgage, I have your estimate. And if it's your first time buying your house, I like to Every town is different. So you have your estimate, what you think you're gonna have to bring to the closing, but when I see the file, you could call me and I could say, oh, you're in Bolton. Bolton's real estate taxes happen to be paid only once a year. So if you're closing in October, you're gonna pay a lot more taxes up. You're not getting ripped off in any way, but Bolton just requires your taxes to be paid once in July. So there's gonna be a larger escrow. There's gonna be a larger amount that you may due back to the seller when you close because the seller has prepaid their taxes. There's oil, there's propane, there's things that aren't necessarily in the loan estimate because the loan officer doesn't know if there's propane, there's oil, and I can kind of lock it down once I get your contract, the estimate from Members Mortgage and Dutch Point. I can get you to 99% about a month before and say, this is probably what you're gonna have to bring to the closing. So you're not worried and that there's no surprises. I'm always here. I'm always available. My office is my brother. Actually, my mom works here too. So I feel that that's another benefit is that you could talk to me, you could call me, you can email me. And typically all the closings with Members Mortgage goes very smoothly and you close on time. And as a final pitch, I can say I've been a lawyer for, yes, about 28 years. My loan that I have on my house now is through Joe because I trust him. There's a lot of, not that there's other lenders out there and I have done business with them, but I have my own mortgage there because being with Joe, being with a local credit union, you can go in, you can call, I'm sure call Octavia. If you have any kind of problems, it's local. In my opinion, it's the best. So that's sort of how it works. And that's how I got my loan. So back to you, Joe.
Yeah, I appreciate it. Thank you, Dave. That's 100% true. That I didn't pay him to say that. He is an excellent resource for me. And what we try to do, right, as a lender is we want to partner with people who are professionals in the area that we work with. Anybody can be a national lender and just, if you know how to originate a mortgage, I can do one in Nevada. But my competitive advantage is that I am an expert in Connecticut real estate. I only work in New England. I only work with credit unions. So I understand the difference between being a customer and being a member, right? There's a totally different standard of care that goes into being a member at a credit union. It is a true benefit. And so that's what allowed us. We've been in business for 30 years working with credit unions. And the only reason that we stick around, it's not because we're great underwriters or because we have, wonderful documentation. It's because we treat people the way that we would want to be treated. And so that's very unusual in this day and age. I feel like everybody else out there is kind of trying to be more robotic, right? We have all the technology. We work with Accenture, which is like an IBM type company to provide technology for mortgage software. But we also have somebody that when you need to pick up the phone and talk to them, they're standing here ready to talk to you during business hours, on the weekends, nights. I mean, I have people texting me at 2 a.m. because they're freaking out about their closing that's coming out in 2 weeks from now. And my wife's going to kill me one of these days, but I'm addicted to my phone. I always pay attention to it. So it's you never feel like you're not being guided through the process. And that's really what we push for. And that's why we're very, big partnership with credit unions because Dutch Point specific, they take care of their members the same way that we do. So we want to make sure that you are experiencing that when you're buying your home because it is a very stressful time in your life. So thank you, Dave. As we go through, right, so you have your attorney, right? Dave Golas is going to be your attorney. He knows the market. He knows the towns. He knows how to get the file from opening to closing. Now I'm going to talk about realtors. I used to spend a lot more time on this. Realtors, frankly, it's a very low barrier to entry, right? So a lot of people who are not professional realtors, they just have the real estate license and they can offer a bid or they can get a contract signed for you, but that's not really what they do full time. In 2022, when interest rates spiked, a lot of the people who were not true realtors kind of fell off to the wayside. So it's not as big a concern now as before. Before it was, hey, my uncle's brother does this, or my kid's softball coach does this on the side. You want to be with a professional realtor, somebody who's dedicated their life to understanding the real estate market in the town that you're looking for or the series of towns that you're looking at. And what they're going to be able to do is provide you opportunity, right? If you're working by yourself and you're just looking at Zillow, you and 10 million other people are looking at Zillow. If you're looking at a specific town, if the house has already come up and been listed for sale, you may have lost an opportunity by working with the best realtor in that area. Now, every town's different. Every real estate community is going to have different methodologies, different styles, different personas, but you have to figure out what's important to you from a standpoint. Do you want somebody who's really aggressive, who's a really good negotiator? Do you want somebody who's going to handhold you, right, and walk you through the process and be a little bit softer? in the process? Or do you need somebody that's a realist who's just going to tell you how it really is? That is all part of kind of interviewing realtors. So I would say find a list of realtors that are local in the areas that you're looking for, interview them, call them up. It's not going to cost you anything. And then one thing that's kind of a new phenomenon in the market is this idea of buyer's broker agreements. I don't believe in them. I think that they're kind of a scam. But essentially what they are is that you're going to sign something with a realtor that says you're going to work with them for X number of months and that their commission is going to be paid by the seller at 2.5%. Let's just say 2.5% of whatever you're buying the house for. Now, the problem with that is that that's not everybody else's agreement, right? So if the listing agent's only offering 2%, you might get stuck with another 0.5% of the home as a fee for you that you weren't anticipating. And then I wouldn't be able to anticipate. And so those are types of things that I strongly advise you against. If you ever have a realtor that you talk to that you really like and you say, hey, this is my person, but they want me to sign a buyer's agreement, that's okay. Some people, it's part of their standard practice to sign it, but send it over to me. Let me review it first, just to make sure you're not obligating yourself to any fees. If it just says, hey, you're going to represent me as a buyer and we have a 6-month contract, fine. I mean, that's harmless. But you just want to make sure you're not guaranteeing any income on that form that you're going to be signing. So that's something that I think just kind of keep your eye out for. Again, it's relatively new in the industry. Not everybody does it, but they're just going to dedicate a lot of time to helping you see homes and giving you opportunities. So I think they're just trying to protect themselves from you using them for that resource and then turning around and bidding directly with the seller. All right. So realtor, really important. They're going to be your expert. They're going to be your boots on the ground, showing you homes and giving you insider information for the real estate market in the town that you're looking at. The next most important is going to be your lender, right? So you think, hey, listen, every lender is the same. Right? Everybody can originate a mortgage. It's a commodity at this point. What makes it different? So I went over that a little bit with you when I was talking about my experience with Dave. But essentially what we do as a lender is that we put you in contact with the mortgage experts and the person who is tasked with approving your loan, right? So there's never going to be hey, I went and applied for a mortgage. I talked to the sales guy. He was great. And then he took my file and sent it to some underwriter. And the underwriter said I couldn't get the loan. Salespeople are great. It's always nice to have a good salesperson, but you need somebody who has control of the process from beginning to end. And so we eliminated the dual position, just made it one position. So the person you call on the first day, who you talk to and explain your situation to, there's no pass off. Right? You're going to have their direct number. You're going to be able to call them anytime you need something. And they're going to have a detailed understanding of your loan file because they're the one they're basically manufacturing it, making sure that it's done exactly the way that you want. Now, they might not necessarily be able to do everything that you asked for, but at least when you ask for it, you're going to know immediately whether they can or they can't. It's not hey, I have to ask my manager, I have to ask my underwriter. It's, hey, this is what I can do. If you want to do it, great. If you don't, I'm sorry. Again, they're going to have all of your best interests in mind. They don't get paid any more or any less if you choose a different product. They don't get any more or any less depending on your loan amount. It's only based on how many loans that they can produce. So they want to make sure that you get to the closing table, and they want to make sure they get you in a situation where you're comfortable. Okay. All right. So let's talk about the process of bidding on a home. You've gone out, you applied for pre-qualification, you met your loan officer, you're very happy with the whole experience. You have a pre-qualification letter. Woohoo! All right, now you're looking at all the homes that come up for sale, and there's 10 new listings, and you love them all, and you want to go see them all. So you go to all these open houses, and you decide, hey, listen, there's one on 321 Main Street. I love it, right? This is the one for me. I'm going to go make a bid. So you find your realtor, you guys go to the house, you walk through it, you present the offer to the selling agent, and then that usually takes place on like a Thursday, right? There's an open house on Thursday. There's usually an open house on Saturday or Sunday, and they'll call for offers on Tuesday, right? So they usually have those open houses late in the week / the weekend so that you have the time to see the home, review it, talk to your realtor, talk to your attorney, talk to your lender. Monday, you can go in, update any of your pre-qualification letters, or talk to your realtor about the specifics of this one property, or talk to your lender about the specifics of the one property. Then on Tuesday, they're going to review all the bids. By Wednesday morning, they're going to accept the bids, and they're going to be looking to basically go into the inspection period where you're going to hire a house inspector to come out. And you have about a week to do that, right? So from Thursday, when the house listed, to about the following Friday or Saturday, you're going to have a house under contract with an inspection completed. Right? So that's very, very quick. right? From there, you usually have somewhere between 2 weeks and 4 weeks for what we call a mortgage commitment, right? That's when you go through the formal process of getting a mortgage. You're going to send in your pay stubs. You're going to send in your W-2s, your bank statements. We're going to verify that you make enough money, that you have enough money, that your credit is exactly where we thought it was going to be, and that the house that you're buying is worth roughly what you're paying for it, right? So we're going to go through all of that process in that 2 to 4 week period, right? And then typically the closing takes place 2 to 4 weeks after that. So in total, closings take anywhere from 3 to 6 weeks on average, right? That's probably 2 weeks faster than where we were even a couple years ago. So with digital age, everybody's moving faster, and in order to win these bids in a very aggressive market, you have to close loans as quickly as possible, right? You have to get to the closing table as quickly as possible because these sellers want their money. What I can tell you is that we're legally allowed to close a loan in as little as 10 days, and I've done that, right? So we've closed a loan from application to closing in 10 days, which is astronomically fast. If you ask your parents about that, it used to be 2-3 months. Now we're talking about, a vacation, right? On one Friday, you're closing the following Friday, or following Monday. So it's a very quick, it's a very aggressive timeline. You have to be prepared with your documentation. You have to be prepared with your expectations of what the process is going to be. And that's why the pre-qualification process is so important, right? You think that, hey, I'll figure it out on the fly. When you have 10 days, that means you get your fee estimate. There's a 3-day period to review it. You have 4 days to get everything done. And then you send out your final paperwork and you get 3 days to close after that. So it's so aggressive of a timeline that I think it's worth having just the education of talking to the loan officer, the expectation of the documentation, what you need in your specific situation. You might even be able to sign some of the forms ahead of time just so you have them all prepared, ready to go. And then you can get what we call a pre-approval letter, which means that you can send that as part of your bid when you're bidding on a home that says, hey, all of my paperwork's already been vetted, right? And that's something that's going to put you ahead of the rest of the competition. There are lenders out there like JP Morgan Chase and Wells Fargo and Bank of America, national conglomerates, right? They're enormous, right? You're treated like you're enormous. There's no way they could close a loan in 30 days, never mind, 3 weeks, 2 weeks, 3 weeks. Their timeline on closing a loan is archaic. And although, hey, listen, sometimes their rates are great because they have a huge balance sheet. They can put the mortgages on their books. The rates in terms only apply if you get to a closing table. So if you never actually get to the closing, if their rates are a little bit better, not worth it. And then from my perspective, we have very little overhead, right? I'm not having branches all over the country. I don't have, Super Bowl ads and, I'm not naming stadiums after members' mortgage company. So all of my savings go to the credit union members. We beat up the attorneys. Sorry, Dave. We beat up the appraisers. We beat up all of our service providers so that we can get them at the bare minimum cost, right? There's going to be costs. When you buy a home, there's always costs. But we beat them out so we get them as low as possible so that A, your rates and terms are as advantageous as they can possibly be. Your closing costs are as low as they can possibly be. Again, it's a benefit of being a member of this credit union, right? You don't want to be just another number at Bank of America. Even the Citizens banks and the Liberty banks and these types of places, you're just another number, right? Here, you're a member, you are a partial owner, you can set the directive for the credit union, and we're going to treat you that way. So make sure you understand the difference between that Bank of America pre-approval that, they basically make you breathe on a mirror and they hand you a letter, and something that we hand out, which we're going to pull your credit report. We're going to review all of your docs. We're going to make sure that you're a qualified buyer because we don't want you to get your hopes up and then, it all falls apart because some underwriter found something that you weren't anticipating. Okay. So the next thing I want to talk about are just different products that are available to you. So these are not all the products that are available. These are just kind of the most popular right now. So I just want to kind of go over where they are, what the rates are, and what the advantages of each of these products would be. Okay. So the first is just the tried and true. It's a 30-year fixed mortgage, right? Everybody's like, oh yeah, that's what I need. I need that 30-year fix. Now, at the end of the year, the 30-year fix was at about 7.25, something like that. Woo, that's tough to say. At the beginning of this month, it was probably closer to 7.68, 7.5. In the last week, it's come down very aggressively. They like to say that politics don't play anything into interest rate environments, Right after Super Tuesday, we saw a significant reduction in the 10-year Treasury. And so the 10-year Treasury is the leading indicator for mortgages. So if you go to any finance website, type in 10-year Treasury bond, if you watch which direction that's going, that's where mortgage rates are going to follow. So right now, our 30-year is at 6.625%. The national average is just over 7. It's like 7.03% right now. So we have a significantly reduced rate versus the national average, but 30-year fixed is not always for everyone, right? So we also offer adjustable rate mortgages. Adjustable rate mortgages, right? Everybody hears that and they go, oh, no, 2006, 2007, I can't get involved in something like that. These are not the same adjustable rate mortgages that were being offered then. These adjustable rate mortgages are fixed for somewhere between 5 and 10 years. They still amortize down just like a 30-year fixed mortgage would be. So you're essentially getting a discounted interest rate for a 5 to 10 year period. So let's think about the market. It's very aggressive. Prices are as high as they've ever been. Affordability is an issue. And we're getting into a situation where we're anticipating interest rates may be coming down in the next 12 months or so. So you can take a 30-year fixed at 6.625 that's fixed for 30 years, or you could look at a 10-1 arm adjustable rate mortgage is at 6 1/8, 6.125. Right. So the monthly savings between that on a $400,000 loan is about $195 a month. Okay. You can also go with the shortest term, the 5-1 arm, right? It's fixed for 5 years. And so that would be at 5.875. So you're looking at a significant rate differential. On that, you're saving somewhere, I don't know, over that 5-year period, you're probably saving somewhere close to $12,000. And that's the money that's not necessarily going in your pocket. You might be paying that into your principal, right? If you paid the payment for a 30-year mortgage, you'd have $12,000 extra dollars in equity in your home over that same 5-year period. Now, if we're going to trust the analysts and say, hey, 100% of the time they're right, of course not, right? That's never going to be the case. And so that's why a 5-year term may not be as, you may not have that type of risk tolerance that some more aggressive people would have. The 10-year arm is an excellent choice. We have a 7-year arm in between. And again, the 30-year fix is never going to do you wrong. You can always refinance if rates come down, and if rates go up, you're going to be protected. So again, there are circumstances where you're going to want to evaluate these things. You don't want to come into it with the idea of, oh no, I could never think about that. Because the reality is, if you're buying a small condo, right? You just got engaged or you just got married, you have no children, you're buying a 1-bedroom or 2-bedroom condo. I've had more people go, no, I need a 30-year fix, need it. 6 months later, 9 months later, 12 months later, they call me up, Joe, I got to get the heck out of this condo, right? And so they're like, okay, I'm going to buy up again. And they could have saved in that 6, 12, 18 months, a couple $1,000s that they could be using at this for a down payment on a new house. Or they call me and they go, Joe, rates have come down significantly. I want to refinance. And it's like, again, your rate could have been lowered for this whole time period. So these are all things to consider as you're looking at homes. And this is part of being an educated buyer. You want to understand the products that are available to you. You want to understand the programs that are available to you. And you want to understand the differentiation points between them, why it makes sense to do it, why it doesn't make sense to do it. Again, if you're buying your forever home, right? If this is your home that you're going to be in for the next 30 years, it's hard to sell against a 30-year fixed, right? But if you're just out of school or you're in the time of your life where there's a lot of changes, an adjustable rate mortgage make a lot of sense for you. Okay. All right. So the next things I want to go over is just a couple of tips for aggressive markets. All right. So if you joined us before, I've kind of given similar tips. They continue to be productive. They keep on working in competitive situations. So I'm going to keep shouting them from the rooftops. So the first is just bid differentiation, right? So when you go out there and everybody's looking at the same house, it's all listed for $225,000, let's just say. And there's 25 people looking at it. They're all going to bid on it. It's almost like you're cheating off each other's homework, right? You usually bid in bands of, let's just say 5,000, right? So 225, 230, 235, 240, right? So what I ask you to do is break that mindset, right? So if you're looking at the house that's 225 and you're willing to bid 250 for it, don't go 250, go 251, 300, right? It's $1,300 more. Your down payment requirement is another couple $100, not a whole heck of a lot. The monthly payment is $9 a month, $8 a month in the current interest rate environment. So the reality is it's really inconsequential for over a 30-year period and you might get the house over $1,300, right? Because if there's 10 bids at 250,000, the seller gets to make the decision. Whereas if you're the highest bid by even the smallest of margins, it may allow you to kind of jump away from the pack, catch the seller's attention, and get your bid accepted, even if in a situation where there's a lot of people all in the similar price range. Okay. This one is an interesting one because there's a lot of motivations when you're selling a home, right? So some people, hey, I need my money now. I need it now, and I need to get out of here next week. I already have another house I'm living in. I'm carrying 2 mortgages. I want to get out, right? In that circumstance, cash is king. Whoever can close the fastest, we're going to make a bid that is as aggressive as we can possibly make it. But there's some people, hey, listen, I've been in this house for 40 years. Right? I've raised my whole family here. I have endless amount of belongings I have to clean out. I can't get out of here in 2 weeks. I can't get out of here in 30 days. So in that case, they might need extended time, right? So what I say is when you're making a bid, don't make it a 2-week bid. Give some flexibility to the seller. Hey, I'll close anytime 30 to 90 days at the seller's discretion. Now, you may not be the highest bid there, but they might say, hey, listen, all the higher bids are closing in 2 weeks. I can't be ready in that time. I like this one because I can control the process a little bit more. So I'll leave some money on the table for my own ease of use. Again, is it going to work every time? No, people like money. But these are kind of tips that you can use in order to give the seller a sense of control, give them a comfortability with you as a buyer, and then it doesn't necessarily impact you. Now, if you have a situation where you're selling your house or your lease is up or something like that, these may not work for you. But if you're living with family or if you have a lease that you can get out of within a month or so, it really is not going to kill you one way or another. This is a good way to kind of not financially incentivize the seller, but kind of the soft, intangible things that you can do to get your bid accepted. Okay. And then the last thing I want to talk about is this idea of an escalation clause, right? This became very popular in 2018, 2019, 2020, and 2021. The market went haywire. Rates were insane. This kind of disappeared. And now it's kind of making a comeback. So an escalation clause is a good way to protect yourself as a buyer if you're willing to bid a higher amount than the initial offering. When there's a lot of people looking at homes, you're fearful that they may get bid up over the asking price. That's very typical in this market, but you may not necessarily want to lead with your chin, right? So that same house we were talking about, 225,000, say, hey, listen, I'm willing to go up to 275. And now if you bid 275 and the next bid below you is at 250, you just overpaid for that house by $25,000, right? So what I would say is that you should go in with an escalation clause, which says, hey, my bid is your asking price, 225,000, but I'm willing to beat the next highest bid by up to, let's just say 5,000, right? All the way up to $275,000. So if somebody comes in at 270,000, you bid 275, right? And you get the house. But if somebody comes in at 250, you only bid 255,000. Now, these are not set in stone. There's a couple of different variations in the way that they're written. So you want to be a little bit careful because you got to make sure you put a cap on it, right? Because it could be some crazy person comes in and goes 250, I want it for $1 million, right? And then now you're like, oh, I didn't want it for $1 million, 5,000. So those are the types of things you have to protect yourself from and make sure that your realtor understands that. And then the other thing is that you need to have a consequential raise, right? If you come and go, hey, I'll beat the next bid by $1. I think some people will kind of see that as cheating the system, and it's not significant enough of an advantage for the seller, so they kind of toss your bid to the side. And you have to kind of figure out where the motivation is. If you're bidding on $1 million homes, 5,000 might not be enough. If you're bidding on $100,000 condos, 5,000 might be too much. So all of those things kind of play into it. And again, that's where having a good realtor, understanding the market, being able to explain it to the seller, how you came up with your methodology, all becomes pertinent. I like to tell this story. It's a funny story, but basically there's a hypothetical seller, right, who's out there and she gets a letter from the one of the bids that says, hey, I saw this tire swing in your front yard. I can picture my children out there swinging on this tire swing, and I love your home. I just need to buy it. I want to buy this house. All right. And then you submit your bid without the letter, and you have an escalation clause that outbids them by $500. And for $500, the seller's sitting there going, oh, I had my kids on that tire swing. I want her to have her kids on her tire swing. Okay. And then they toss your bid. Even though you were the highest bid, she's going to toss your bid to the side because they wrote this beautiful letter. Now, if you make it consequential and it's 5,000, she totally forgets about the tire swing and she's going to take your bid, right? So make sure that you have an impactful escalation on your clause and make sure that it's something that the seller understands your motivation. It's not necessarily trying to cheat the system. It's, hey, I want this house better than anybody else, and I'm willing to pay for it. Okay. So at this time, there's a lot of things I threw at you. I talk really fast. So I want to make sure that everybody has a couple of things before we end. One, I'm going to send in the chat box. I'm going to put all my contact information, email, phone, however you want to get in contact with me. Ask questions about your specific situations. I'm happy to answer them. And then the second thing I'm going to give you is a promotional code. When you apply for a mortgage, you're going to go on Dutch Point Borrowing Mortgages, and you're going to see on there that in the application that you have to pay a $25 application fee. Credit reports cost somewhere around $75. I'm willing to pay for that for you guys because you're demonstrating that you want to be here and that you're serious about buying. So I'm going to give you a promotional code to bypass that, defers the cost of the closing. So you get a pre-qualification letter for no cost. You get to talk to the experts ahead of time at no cost. So all of those things, if you use the promo code, so the initial part, you put in your name, your birthday, your social, all that kind of stuff. And then the next is going to ask you to pull a credit report. And when you go to do that, they're going to give you a box to put in your credit card. Instead of putting in your credit card, put it in the promotional code, and it's loan 4, LOAN, and the number 4. And that's all in lowercase letters. So if you use a capital, it will not work. And so again, that will just allow you to bypass that $25 charge, complete the application at no cost to you. And then you'll be off and running, meeting your expert and being in a situation where you're going to be an educated buyer and hopefully be successful in finding a new home. So at this point, I think that I'm open to questions if anybody wants to type questions in the chat box.
So while they're typing, I do have some questions for you. And the first question is, are you considered a first-time home buyer only once in a lifetime?
Great question. So no, from a mortgage underwriting standpoint, no, you can be a first-time home buyer more than once in a lifetime. Sounds crazy. You're a first-time home buyer if you haven't owned a home in the last 3 years. Okay. And if any applicant on the application has not owned a home in the last 3 years, the entire application is considered a first-time home buyer. So say, you're co-signing with your parents or something like that, and they own a home, but you've never owned a home. Totally fine. You would be eligible for first-time home buyer programs, even though you have somebody on there that may even actively own a home now.
Oh, that's a good benefit. So the other one was, you mentioned that we'll be able to speak to someone. Is that sort of like credit counseling, or is it a journey map that we need to fulfill?
So you don't necessarily need to talk to anybody. We can do it all through emails and text messages and all that kind of stuff. The reality is that in some circumstances, we'll be able to credit counsel you, right, and talk to you about different things on your credit report. We are not one of the agencies that go in and rectify your credit, right? If you have delinquencies or bankruptcy or foreclosure, things like that, you need to get settled. There are attorneys, there are credit repair companies that will do that. We are more of an identification, right? We'll go through and say, hey, this is impacting your credit. This is a problem. This is something you might want to get fixed now. Or, hey, you're not eligible because of XYZ. If you can get this fixed up, we can help you. And we can kind of point you in the right direction, but the actual fulfillment of that, we're not going to be doing any counseling on that.
I would like to add, Dutch Point, we do offer financial counseling, but to Joe's point, we're not the ones that's taking off your credit. We're just kind of helping you map that out. So what a lot of the members do, they go and they speak to Joe and his team, and they give them the pointers like, hey, we think we can get you in the house, but you got to clear up these things. And then you come over to us and we have a deeper conversation and talk about, how to squirrel money away, things to tackle first, to even help you to supplement what Joe's offering so you can go back and get into that house. Another question, just checking the time here. What happens when the appraisal is lower than expected? Will I be forced as a buyer to put more than 3% down?
So this is a great question. The 3% down is a very unique scenario. So basically, one of the values that we look at is this concept called loan to value. And what we do is we take your loan amount divided by the lower of the appraised value or the purchase price. So if the appraised value comes in under the purchase price, right, then in that scenario, we would take your loan amount divided by the appraised value. And if that ratio is is greater than 97%, your loan is ineligible, right? Now, I can deny your loan right then, and you get your deposit money back and you can move on to another property. Or there's really three paths. The first is I deny it. Loan's dead. You don't want to put any extra money down. You're not interested in moving forward. You made a mistake. Your bid was a little too high and you're not comfortable with it anymore. No problem. I issue you a denial notice saying that the collateral isn't worth what we thought it was. You give that to the seller. They're obligated to give you your deposit money back, assuming that it's before your mortgage contingency date and that you have a mortgage contingency. And then we move on to the next property. The second is you can go back and renegotiate with the seller. The reality is that a lot of these properties, if you're going to get an under appraisal from me, you're going to get it from pretty much anybody else out there. So the seller has to be reasonable in their expectations, right? If they're out there thinking their house is worth $500,000 and you came out with a $500,000 bid, and then you come to find out it's only worth $450,000, in that case, I'm going to back up. Let's say an appraisal, when you're having appraisal done, it's not like an inspection. They're not going to come and look at the warranty or the lifetime of a roof or your boiler. What they're going to do is a comparative analysis of the subject house that you're buying versus other homes of similar characteristics in the area that you've bought that have transacted in the last usually 6 months. It's usually 3 to 6 months. And so what they want to do is say, okay, this house down the street sold for $500,000. This one sold for $450,000. This one sold for $475,000. And they look at the characteristics of each of the homes, and then they come up with a representative value of this home based off of this home's characteristics versus those comparable properties. Okay, so if you do this analysis, there's only so many homes that have sold in the last 3 to 6 months. So it's not like they can ignore different prices that have printed in the market. So the appraisers are all going to come in within a tight bandwidth of each other. So if they're going to be underappraising with one appraiser, they're probably going to underappraise with another appraiser. So if you go back to the seller and say, hey, listen, these are the comparable properties that were used. I don't know how you're going to be able to sell this at $500,000. I'll still buy it for $450,000. In that case, most of the time they'll come down to $450,000 because that's what the market's going to warrant. Sometimes they'll try to negotiate and split the difference or something like that. But again, you're not obligated to it. You can always walk away from the transaction in this scenario. And then the third is that you can bridge the difference in cash, right? So say you thought it was worth $500,000, it appraises for $490,000. You could put down additional money to get to 97% of $490,000. And that would allow your loan to be eligible again. And you would be fine there. Now, again, it's going to be more than 3%. It's probably going to be 4.5% or so. You're not obligated to do that, but we could give you that scenario in the specifics. But again, you have three options: bring more money, renegotiate the price, or walk away.
Thanks, Joe. Another question. Where is that? So if my credit score was to change during my rate lock period, would that impact my loan rate?
Great questions, though. These are great questions. So during your rate lock period, we don't do multiple rate or credit pulls. So when you initially apply for your mortgage, for your pre-qualification, we're going to do a hard credit pull. We're going to establish your credit scores. That credit report's good for 120 days. After 120 days, that credit will expire, right? And so say we get your contract within the 120 days, but we realize the closing date is going to be outside of the 120. At that point, we're going to pull a new credit report, right as we're offering you rates and terms. So then you'll know for another 120 days, you're good to go. Now, what some lenders will do is not realize your credit's going to expire. And in the middle of the process, they're going to pull your new credit. And then if your credit score goes down, it could impact the rates and terms that are offered to you, right? We were talking about those credit bands. You could go from 780 to 779, and that could be an eighth or a quarter difference in your interest rate. That's crazy to me, right? You want to know exactly what your rates and terms are going to be the day you have a contract. Now, you can't lock in your rate until you have a property under contract with a determined closing date, right? So it's not like you can apply for pre-qual now and say, hey, I want to lock in that rate. Not how it works. But the good thing is that hopefully in the next 12 months or so, rates are heading in a downward trajectory. So you might be able to be looking at rates now, and 6 months from now, your rates might even be better.
Thanks. I saved the easy question for last.
Mm-hmm.
If I want to be prepared, where do I find a checklist?
Okay, so right on the mortgage application online, there's a checklist of everything that you could possibly need for applying for a mortgage. One thing I will warn you against: don't feel obligated to have every one of those things. Okay. The reality is sometimes it's not pertinent to your situation. So your best thing you can do is just create a username, password, start the application, get your, your mortgage expert to call you and or email you, whatever is your preferred method of contact. And then that person is going to be able to see your specific situation and then ask you exactly what they need. Right. And so if we get in a situation where you have 800 credit, you get 25% down and it's all at Dutch Point and you make $1 million a year. I'm not going to kill you for documentation the first day you apply because I know you're going to qualify for your mortgage. I can see it right on the paper. But if there's a situation where we're fearful that anything is going to make your loan ineligible, right? Your debt to income ratio is a little bit close to the highest, or your credit's a little bit mediocre, or your employment history is a little bit chopped up. In that case, we're going to collect all this documentation now from the first day. We'll be able to review it and then either A, come up with a plan which will make you eligible in the future, or B, say, hey, listen, you need to get a year at your job, or we need to save a little bit more money, or we need to have a little bit more of a down payment in order for you to qualify.
Thank you. That concludes this session. I appreciate your time, Joe. I appreciate your time, Dave. And I appreciate all the members and potential members that have joined us today and giving us some time this evening. This will be available on our social media if you wanted to share it with others. And we'll be back again sometime later in the year with a new topic, right, Joe?
Looking forward to it.
All right. Thank you, everyone, and have a good night.
Thank you, guys.
Bye.